Wait, before you dive into real estate investing, watch this video and get the crucial tips. It could make all the difference. Hey champs, welcome to the Moneymind Quest. In today's video, we discuss real estate investing 101 steps to achieve financial freedom. If you are all about making smart personal finance decisions, then you want to join the Moneymind Quest champs by simply smashing the subscribe button and sticking around till the end to uncover things to avoid in real estate investing. All right, let's dive into the world of real estate investing. Have you ever wondered why wealthy people invest in real estate? Well, they invest in real estate because it often provides stable returns, potential for appreciation, tax benefits, and diversification of their portfolios. For instance, Warren Buffett's Berkshire Hathaway has made substantial investments in real estate through its subsidiary, Home Services of America, a leading residential real estate brokerage in the U.S. Real estate acts as a hedge against inflation, as property values and rental incomes typically increase, maintaining purchasing power thereby. Additionally, real estate investments generate passive income, offer tax advantages through deductions and depreciation, and serve as tangible assets that often hold value better than stocks during economic downturn. Investing in real estate can be a potent strategy for accumulating wealth and attaining financial freedom. It's a tangible asset, often less volatile than stocks, and it offers multiple ways to generate income. But like any investment, it requires knowledge, planning, and strategy. Real estate investing involves purchasing, managing, and selling properties to generate income or capital appreciation. This can include residential properties like single-family homes and apartments, commercial properties like office buildings and retail spaces, and even land. Educate yourself before diving into real estate investing. It's crucial to understand the basics. Do some research, read books on it, attend seminars, and follow reputable real estate investors, blogs, and YouTube channels like the Moneymind Quest to understand where investments belong in your personal financial structure. The greater your knowledge, the better equipped you will be to make informed decisions. Define your goals based on your research. Determine what you want to achieve with your real estate investments. Are you looking for a steady income, long-term appreciation, or a mix of both? Your goals will influence your investment strategy and the types of properties you consider. Define your long and short-term goals. Assess your finances. Evaluate your current financial situation. Before venturing into real estate investment, it's essential to establish a robust financial base. This involves maintaining a strong credit score, having an emergency fund, and thoroughly assessing your financial health to understand your risk tolerance level. To do this, ensure the following. Assess your credit score. A favorable credit score enhances your ability to secure favorable financing terms, as lenders will consider your creditworthiness when approving mortgages. Save up a down payment. Depending on the property type, aim to accumulate a minimum of 20% for a down payment. Maintain an emergency fund. Ensure you have funds reserved to handle unforeseen expenses linked to your investments. Choose your investment strategy. There are several real estate investment strategies, each coming with its own benefits and risks. The options include buy and hold, purchasing properties to rent out and generate ongoing income, fix and flip, buying properties, renovating them, and selling them for a profit, wholesaling, contracting properties and selling the contract to another investor for a fee, REITs, real estate investment trusts, investing in a company that owns, operates, or finances income-generating real estate. Choose a strategy that matches your objectives and risk tolerance. Research planning, conduct market research, and start small. Perform detailed research to pinpoint the most promising locations and property types for your investments. Examine market trends. Investigate factors such as property values, rental prices, and vacancy rates in various areas. Evaluate economic indicators. Monitor local economic conditions, employment growth, and population changes. Begin with a small investment to gain experience without taking on too much risk. A single-family home or a duplex can be a good starting point. This will help you learn the ropes of property management, tenant relations, and dealing with maintenance issues. Secure financing. Unless you have enough cash to buy a property outright, you'll need financing. Explore various loan types and lenders to discover the optimal fit for your requirements. Engaging with a mortgage broker can assist in navigating the multitude of options available. Obtaining the right financing is crucial for your real estate investment. Explore various options and select the one that aligns best with your needs. Some of the most popular options are traditional mortgages, suitable for long-term investments such as rental properties. Hard money loans, short-term, high-interest loans ideal for fix and flip projects. Private money lenders borrow funds from individuals and non-traditional institutions. Partnerships team up with other investors to combine resources and share risks. Securing financing for real estate requires careful navigation to avoid common pitfalls. One crucial aspect is to avoid taking on high-stake commitments right before closing, such as opening new credit lines or making large purchases, as these can negatively impact your credit score and debt-to-income ratio, potentially jeopardizing your loan approval. Additionally, it's wise to aim for a substantial down payment if you can avoid private mortgage insurance (PMI), which adds extra costs to your mortgage without benefiting you directly. Also, be cautious of bank mortgage insurance payable to the bank, as it primarily protects the lender, not you. Understanding the different types of mortgages is also essential. Fixed-rate mortgages offer stable interest rates and predictable monthly payments, making them suitable for long-term planning. In contrast, adjustable-rate mortgages (ARMs) have variable interest rates that can fluctuate, which might be beneficial if you plan to sell or refinance before the rate adjusts, but can be risky if rates increase. Carefully consider your financial situation and investment goals to choose the mortgage type that aligns best with your needs. Avoiding these pitfalls and making informed decisions can help secure favorable financing for your real estate investment. Be sure to watch till the end to uncover things to avoid in real estate investing. Find the right property. Look for properties in areas with strong rental demand and potential for appreciation. Consider factors like location, neighborhood quality, property condition, and local market trends. Use online real estate platforms, attend open houses, and network with real estate agents to find opportunities. When finding a real estate property to buy, ask about the property's history, condition, and market value. Inquire about the neighborhood, future development plans, and any potential zoning issues. Look for patent defects such as visible structural issues, plumbing problems, or outdated electrical systems. Also, be aware of latent defects that are not immediately obvious, like hidden water damage, foundation issues, or mold. Ensuring a thorough inspection can help uncover these hidden problems before purchase. Perform due diligence. Before purchasing a property, conduct thorough due diligence. This includes inspecting the property. Hire a professional inspector to identify any potential issues. Reviewing financials. Analyze the property's income and expenses to ensure it meets your investment criteria. Understanding the market. Research the local market to gauge property values and rental rates. Make an offer. Once you find a property that meets your criteria, make an offer. Work with a real estate agent to negotiate the best price and terms. Be prepared to act quickly, as good deals can move fast. When making an offer on a property, base your bid on comprehensive market research and recent comparable sales to ensure it's competitive yet reasonable. Don't let the agents dictate the pace. Suggest amounts you are most comfortable with. To increase the likelihood of acceptance at the best amount, consider including contingencies that are attractive to the seller, such as a flexible closing date, while also presenting a pre-approval letter to demonstrate your financial readiness. Manage the property. Effective property management is key to a successful real estate investment. You have the option to either self-manage the property or hire a professional property management company. If you plan to rent out the property, the responsibilities will include marketing and leasing, finding and screening tenants. This requires understanding and applying related laws and regulations in your location. Maintenance and repairs, keeping the property in a good quality condition, rent collection, adequately screen tenants and properly brief them, provide contracts ensuring timely payment of rent and other preferences compliant with the law. Tenant relations, addressing tenant concerns and maintaining positive relationships. Understanding and planning for taxes can greatly impact your real estate investment returns. Work with a tax professional to maximize benefits and minimize liabilities. Tax deductions, utilize deductions for mortgage interest, property taxes, and depreciation. Mortgage interest on investment properties is tax deductible, reducing your taxable income. Here's how. Determine eligible interest. The interest you pay on your mortgage throughout the year could be eligible for deduction. This amount is usually provided by your lender in an annual statement. Itemized deductions. To claim the mortgage interest deduction, you must itemize your deductions on your tax return. This involves listing all eligible expenses instead of taking the standard deduction. Report on Schedule E. If you are in the U.S., report the deduction on Schedule E. Reducing taxable income saves money. For example, if you paid $10,000 in mortgage interest and are in the 24% tax bracket, you could save $2,400 in taxes, enhancing cash flow and profitability. Over-leveraging, taking on too much debt can be risky, especially if the market turns or you face unexpected expenses. Aim to maintain a healthy debt-to-equity ratio and have a financial cushion for emergency. A healthy debt-to-equity ratio in real estate is typically around 70-30, meaning 70% debt and 30% equity. This balance allows for leveraging the investment without taking on excessive risk, maintaining financial stability, while optimizing potential returns. Ignoring market research. Failing to research the market can lead to poor investment decisions. Stay informed informed about local market trends, economic conditions, and property values. Underestimating costs. Real estate investing comes with various costs, including maintenance, property management, taxes, and insurance. Ensure you factor these into your budget to avoid cash flow issues. Skipping due diligence. Not conducting proper due diligence can result in purchasing a property with hidden problems. Always inspect properties, review financials, and understand the market before buying. Consider if you might need title insurance. Build a strong network. Networking is crucial in real estate investing. Connect with real estate agents, lenders, contractors, property managers, and other investors. A strong network can offer valuable insights, opportunities, and support throughout your endeavors. Create a business plan. Develop a detailed business plan outlining your investment strategy, goals, and financial projections. This will help you stay focused and organized as you grow your portfolio. Continuously educate yourself. The real estate market is constantly evolving. Stay informed about market trends, regulations, and best practices to secure your investments. Attend workshops, join real estate investment groups, and keep learning. Diversify your investments. Diversification can reduce risk and increase potential returns. Consider investing in different types of properties and markets to spread your risk. Monitor and adjust. Regularly review your investments to ensure they're performing as expected. Be prepared to make adjustments as needed, whether it's raising rents, making improvements, or selling underperforming properties. Financial education is crucial for both new and experienced investors. For newcomers, understanding the basics of real estate investing can help avoid costly mistakes and set a strong foundation for future success. For seasoned investors, continuous learning ensures you stay ahead of market trends and adapt to changes. Investing in your financial education can lead to better decision-making, increased confidence, and ultimately greater financial security. Whether you're just starting or looking to expand your portfolio, make it a priority to stay informed and educated about real estate investing. Remember, the journey to financial freedom starts with building a solid foundation by quality learning. So don't forget to join the Money Mind Quest champs by simply hitting the subscribe button. Check out this video and see you next time.